case you missed it, welcome to IGCSE Accounting. Today we'll be looking at the introduction to bank reconciliation. Today we want to understand why the transactions are opposite for the debits and the credit entries when it comes to the cash book and the bank statement. When it comes to bank reconciliation, this is the process used to ensure that the company's records of its bank account matches the bank's records. This is important because discrepancies can occur for various reasons, such as outstanding checks, deposits in transit, bank fees, or errors. So basically, as an accountant, you want to make sure that money going in and out of the business account matches the money going in and out of the actual bank statement. So, what is a bank statement? The bank will send you a bank statement at the end of every month, detailing the money coming into your bank account and out. The bank will also maintain an account for the business to record all the transactions the business has had with it. So all the money coming in and going out will be recorded by your bank. The bank will send its customers a bank statement at regular intervals. The bank statement is a copy of the bank's records of the business account. So you can check the bank statement and match it with the transactions happening in your business. When a customer gets the bank statement, they can check the balance with his own cash book to make sure that they agree. The money going into the cash book should be the same as the money going in and out of the bank account. The total at the bottom of the bank statement shows the money remaining in the account and should agree with the balance carried down in your cash book. So the first thing an accountant should do is make sure that the balance carried down in the cash book matches with the final balance in the bank statement. So you, the accountant, will get this statement every month, normally at the end of the month. When you get it, you'll see and make sure that the bank balance matches that with your bank statement. You also will realize that some transactions might not have been processed at this time. So either something hasn't gone through or it will be processed at a later date. So this won't yet be reflected. But before we go any further, let's see why the bank statement has a credit balance when money goes in and a debit balance when money goes out. This is different from our cash book. When a customer goes to the bank to give their money in, they are giving it to the bank to look after and keep safe. In return for this service, the bank charges a small fee every month for keeping the customer's money. When the customer goes into the bank to deposit money, it's not giving ownership of the money to the bank, but rather giving it to the bank to keep for them in return for a charge. So when customers give money to the bank, who does the money actually belong to? Does it belong to the bank or is it still belonging to the customer? When a customer goes in and deposits money, the bank does not take ownership of this. The money still belongs to the actual customer. It just means, however, that the bank is keeping it for a service charge, but the money is still owed to the customers. The bank still owes the money to the customer. This is a liability. So remember, anytime you owe someone else money, this is a liability, which is always a credit. So in the bank's accounts of the customer, it will be in the T account and a credit balance because the bank owes money to a customer. So from the bank's perspective, it's a liability. So when looking at case studies, you will see if the customer puts in money into his own bank account, the bank owes him more, the credit side of his bank statement will increase. But if the customer takes out money, the bank owes them less. So this will go to the debit side. So whenever you see a debit entry on your bank statement, the amount of money that they owe you is less. Looking back at our example, you can see that on the 9th of June, there was a deposit made into the bank. This means that money was put into the bank. It goes onto the credit side because the money owed to customers increases. So this amount of 500 on the 9th of June, money put in will be on the credit side because it increases the amount of money that the bank owes the customer. We can also see this on the 18th of June, a deposit was made of 1,900, and we can also see it a little further down. So whenever a credit transaction or deposit is done, we know that money goes into the bank account. For the bank, they owe us more money, which means it's a liability, and it goes on the credit side of their bank statement. On the next one, we can see that there's actually an amount going out of the bank account for 410 on June the 12th. The customer has obviously gone to the bank and withdrawn money out of their account. So the 410 comes out of their total amount that is owed to them. So the bank owes them 410 less. So when you see a debit transaction in the bank statement, it means that money is going out and the balance owed to the customer is less. It's reducing. The same can be seen on June the 17th for 230. And if we go further down on June the 29th, we can see that 140 has been paid, going out of the account, reducing the amount of money that the bank owes the customer. On the far right-hand side, we can see a running balance, and this is the balance increasing and decreasing depending if money is put into the bank account or money is taken out of the bank account. Again, on the 9th of June, we can see that 500 was put into the account, which means that the overall balance that the bank owes the customer is now 8,400. On the next one, we can see that there's actually an amount going out of the bank account for 410 on June the 12th. The customer has obviously gone to the bank and withdrawn money out of their account. So the 410 comes out of their total amount that is owed to them. So the bank owes them 410 less. So when you see a debit transaction in the bank statement, it means that money is going out and the balance owed to the customer is less. It's reducing. As we look further down on June the 17th, we can see that there was a credit transfer of 230. That is a debit, which means that money came out of the account. The amount of money that the bank owes the customer has now reduced to 7,760 from 7,990.
In summary, this has been an introduction to the bank reconciliation section. We have seen that when a customer deposits money, it is a debit in the cash book and a credit in the bank statement. If the customers, however, withdraw money, it is debit in the bank statement and credit in the cash book.